You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Airtel Africa, Boohoo, Deutsche Post, Shell, Sage, and our US company of the week is Disney. Sam, do you want to start us off with Airtel Africa?
Yes, favorite of the show. For anyone who's not familiar with the company, they offer mobile and data services in, I think it's about 13 or 14 African countries. We've covered them a few times on the show and they are a favorite. So yeah, they've come out with their full year results. Revenue is up by 20.6% for the year to $4.7 billion. And all these figures will be in dollars. And 17.8% growth for revenue in Q4. Constant currency underlying revenue grew 23.3% for the year and 19.1% in Q4. Constant currency underlying revenue growth was strong in all regions, with Nigeria up 27.7%, East Africa up 22.7%, and Francophone Africa up 17.2%. And across all key services, with revenue in voice up 15.4%, data up 34.6%, and mobile money up 34.9%. Underlying EBITDA of $2.3 billion grew by 29% in reported currency. Underlying EBITDA margin of 49% was up by 294 basis points. Operating profit grew by 37.2% to $1.5 billion in reported currency. Profit after tax grew by 82% to $755 million. Earnings per share was 16.8 cents, which was up 86.5%. Operating free cash flow was $1.655 billion, up 40.5%, with net cash generated from operating activities up 20% to $2 billion. Over the last 12 months, the business has repaid nearly $1.4 billion of debt in the holding company as a result of strong cash upstreaming across its operating companies and proceeds from minority investments in mobile money and tower sales. The leverage ratio improved to 1.3x from 2x in the prior year, with $1 billion of debt now in the holding company, and that's down from $2.4 billion a year ago. The customer base at the end of the year was 128.4 million, and that's up 8.7%, with increased penetration across mobile data, with the customer base up 15.2%, and the mobile money customer base up 20.7%. The NIN SIM regulations in Nigeria impacted customer growth in H1, but then returned to strong growth, adding 4 million customers in Nigeria in the second half. The board has recommended a final dividend of 3 cents per share, which takes the total dividends for the year up to 5 cents per share, and that compares to 4 cents a share last year. In terms of the split of revenue by region, voice revenue was up 15.4% to $2.358 billion. Data revenue was up 34.6% to $1.525 billion. Mobile money revenue was up 34.9% to $553 million. It's worth adding as well, we've talked about this before as well, but the mobile money is one of the really exciting things about this, because of the $4.7 billion revenue, mobile money is only $553 million. It's growing very highly, and really, it's sort of PayPal combined with a traditional bank. But when you look at the number of unbanked people in Africa, the number of people that are using mobile as a primary way to access a bank account now, I think the opportunity for this alone is absolutely huge. And then you get all the other stuff inside it, which is just also growing really well. And then other revenue was up 19.9% to $407 million. In terms of the key performance indicators, average revenue per user grew 13.5% to $3.2. The total customer base was up 8.7% to 128.4 million. The data customer base was up 15.2% to 46.7 million. And the mobile money customer base was up 20.7% to 26.2 million. In terms of the valuation, the company trades at a market cap of 5.4 billion and a PE ratio of just 10.5. I think the PE ratio is worth commenting on as well. For the growth, I mean, these figures are fantastic. For the growth, that PE ratio is insanely low. There are risks with it, especially in the companies it operates in. But it's really interesting because that PE ratio is about what it was when we first started covering this business a year ago. However, the share price over the last 12 months is up 81%. But that share price has basically just gone up in line with the earnings. We've not really seen any multiple expansion on this. And I know you shouldn't buy a business for multiple expansion, but the earnings are growing so well. I'd be happy with it if it carries on growing like this and stays at a PE of 11. But when you look at other stocks listed, even on the FTSE, it wouldn't surprise me if in a few years this was trading at a PE of 30 plus. And that would be a 3x straight away. And that's assuming the earnings. And if the earnings carry on growing as well, I do think it does have serious multi-bagger potential, this.
Why do you think the sentiment is sort of more negative towards it, which is sort of, I suppose, reflected in that multiple? Do you think it's like you sort of alluded to with the sort of countries that it operates in and the regimes there?
I think it's partly the countries it operates in. Debt used to be a big issue, but that's much less of an issue than it was than it was a few years ago. That debt ratio of 1.3x isn't really concerning now. That used to be 9x, which was very concerning. The tax rates in the countries it operates are quite high. I think it's about 40%. It's majority owned by Bharti Airtel in India, which I don't have an issue with that. A lot of the staff members actually moved over from Bharti Airtel. They've got every incentive to see it succeed, but the shareholders don't have control of it. Bharti Airtel, the Indian company, does. I don't have an issue with that because I think there's definitely been net benefits to this business from the Indian business, like with all the staff that have come over. And as well, you would get into the argument that, you've got a lender of last resort and that kind of thing. I don't know. I like a year ago, I felt like it wasn't being covered that much. It's on the FTSE 100 now. So I'd have thought we'd start to see that improve a bit more. It doesn't seem to have happened yet, but the regimes are quite important as well. It does operate in countries where they've not got the strongest currencies.
Sure.
So it might grow 30% a year revenue, but it's a real growth rate of 20% because the currency's depreciated against the dollar, which they measure in. But the growth rate's so high that, when you look through the figures since it went public, that's never been an issue. So there are risks, and I understand it, but I mean, I'm more than happy to hold this at a PE of 10.5. So, John, what are your thoughts on these results and Airtel Africa as a company and the valuation?
Yeah, I mean, I'm a shareholder too. I must have bought in about 6 months ago or so, and I think the results were impressive. Obviously, there are those sort of concerns which are probably holding back the multiple that you've mentioned, but I think there's lots structurally going for it. And the fact that they don't have all the infrastructure for fibre or broadband in Africa, but there's that growth in the data, and that is where people are going. And exactly the same with the banking, the mobile banking, and it's benefiting from those two things massively. The voice you're much less interested in, but it's the data and the mobile money. And so far it just seems to be continuing. So I think it's really, really good. Really happy holding the company. And I suppose the valuation does reflect those concerns, but I don't think it probably prices in all the growth that it's continuing to have and has had the track record since listing a few years ago. So I would happily buy more shares in Airtel Africa at the moment.
No, I would as well, especially that. I think you've got to be careful with it, not to anchor to the price, because it's up 80% in a year, but the earnings are up 80%. So in terms of valuation, it's just as cheap as it was when we first started looking a year ago, which is ridiculous, really, considering the figures it's put up.
And I think you're probably anchored at a lower price than I am, but still.
So I think my average buy-in, I think, is about mid to high 80 pence.
Yeah, I think I'm somewhere. Well, actually, no, I'm probably in the sort of mid 80. I don't know, something like that. But anyway, that's not important. That's not relevant, really.
Well, no, and as well, it's a valuation. It's not the price, because the business has grown by. It's 80% bigger in terms of earnings, so it should. Otherwise, I mean, that P would be even better. It'd be like 6 or something.
Absolutely, exactly. Well, we do have some companies that are that cheap in the show this week. Okay, we'll go on to Boohoo then, which is the largest fashion retailer on the AIM, and they had their full year results out earlier this month, with full year revenue up 14% to £2 billion and 61% ahead of 2020, with a strong performance in the UK offsetting a small decline in the international sales. EBITDA, however, was down 28% to £125.1 million as a result of cost inflation, with higher shipping and marketing spend, which was in line with the group's previous guidance. Encouragingly, the number of active customers was up 10% to 19.9 million and 43% ahead of 2020. and average order value rose by 8% to £48.16, albeit with a smaller number of items per basket, now averaging 3.04 compared with 3.34. In terms of the regions, the UK saw revenue rise 27% year on year and 77% ahead of 2020. But return rates continue to increase to pre-pandemic levels, with fewer higher ticket items which were at greater risk of being returned. Gross margins came in at 49.4%, down from 50.9%, with price rises not managing to offset the increase in costs. In the rest of Europe, revenue was down 10% to £219.2 million, with extended delivery times and a slightly higher return. Gross margins fell 1.7% to 54.5%. Meanwhile, in the US, revenue grew 4% to £451.6 million, which is 71% higher than 2020. However, demand was dented by delivery issues. Gross margins were more or less flat at 59.8%. The rest of the world fell 10% to £109.2 million, with delivery issues impacting on demand also. Gross margins fell 2.45% to 52.5%. Boohoo had a free cash outflow of £251.2 million, with higher capital expenditure and more than double the £121.8 million cash outflow last year. Net cash was down to £1.3 million from £276 million. The group say that their cost challenges are going to continue into the new financial year and that they're targeting revenue growth in the low single digits and underlying cash profits margin between 4 and 7%. In terms of valuation, Boohoo has a market capitalisation of just over £1 billion and trades at currently around 14 times earnings, compared with an average of nearly 40 since listing in 2014, and it currently doesn't pay a dividend. In terms of these results, I suppose they are what we expected and also what the group had guided for, and they're certainly not the stellar figures that we got used to since they listed in 2014, and they've been badly hit by the supply chain issues and inflationary pressures that have been well known and in the news. I suppose at just 14 times earnings for a business with such a strong track record of growth, and if we take the view that the current inflationary pressures are short-term issues, then Boohoo's infrastructure and brands, which include Debenhams, Dorothy Perkins, Coast, the long-term picture looks a lot more attractive. I do own Boohoo shares and I'm comfortable holding them, but I think if you were going to buy them today, you'd need to be in for a bumpy ride and be looking at that longer term view rather than the short-term headwinds that it's currently facing. Sam, what are your thoughts on these results from Boohoo?
Pretty similar to you. I think we're both shareholders of it. I think it's good that the customers were up in the air. I think that's very good. I like the strategy. They've been investing in capacity, and that is a good strategy if demand picks up again and it goes back into growth mode. I think it will, and that's partly why I'm quite happy to hold the shares. We didn't buy at the top though. It's down from like over £3.50 a share or something to about 80p now. So I think we bought in at about £1.20. I think it might be a year or two away, but I think it will kick back into growth mode. And I think when it does, I think the decision to invest in extra capacity will be the correct one. I also think it's quite nice because it just shows as well that management probably have the same expectations as we do in terms of the growth picking back up, because otherwise they wouldn't be investing in extra capacity. That being said, low single digit growth next year is disappointing, but a lot of it is they've just had issues getting the stuff to customers. And when it's fast fashion, and one of the things that's made help Boohoo do so well in recent years is they've been able to react to trends instantly. When it's so quick to change, if you can't get the stuff to customers quick enough, it is going to hurt it. I'm pretty confident that Boohoo will return to growth. It might not be 50% plus a year, although if it did, that would be a nice surprise. But I can see it getting back to 20% plus growth rates, especially if it carries on growing in the USA. Yeah. And in the USA, where the revenue was only up 4%, that's almost a distorted figure because they've not been able to get the stuff to the customers. So I think they said I think we covered a trading statement they did recently.
Yeah.
And they said they just hadn't been able to deliver it. The supply chain issues meant that they couldn't satisfy the demand. So the demand's there. Once the supply chain issues are sorted, and I think they are temporary, I think that USA revenue is really going to start growing. And that's only 451 million out of 2 billion. And think how big the US is. I think in a few years' time, I think you could look very clever if you bought around these levels.
Okay, that's what you're hoping for yourself.
That's what I'm. Well, yeah.
Well,
the flip side is you look very stupid because you probably in a few years' time you're probably going to have a multi-bagger or a zero. It's probably going to be one of the two. Yeah. I don't think it's still going to be around 80p a share.
Yeah. And we're taking the view that it's going to be a multi-bagger for obvious reasons. But yeah, fine. So on to Deutsche Post.
Yes, a company we don't own, just to mix it up. So Deutsche Post, they're basically the Royal Mail in Germany, and they also own DHL, which is the biggest international parcel shipper in the world. We have covered them once before on the show, and I think we did like it. I think it looked like a good business. So they've come out with they're actually listed in Germany, by the way, but we'll still count. We're not counting it as the foreign company of the week. So they have come out with their Q1 results, and revenue rose 19.8% to 22.6 billion. And these figures are all in euros. And that partly reflected favorable exchange rate movements. Higher expenses meant operating profit rose more slowly, up 13% to 1.9 billion. There was growth in all but two divisions, which were held back by very strong comparisons this time last year. Express revenue, excluding the effective exchange rates, rose 12.5% to 6.4 billion. Shipment volumes fell, but there was an overall increase in revenue in all geographies, and operating profit rose 1% to 971 million. Global forwarding freight rose 51.2% to 7.4 billion, with global forwarding far outpacing freight. Improved US and European trade lines resulting in a 3% increase in air freight volumes, with operating profit more than doubling to 601 million. Strong performance from retail, life sciences and healthcare and consumer helped supply chain revenue rise 13.3% to 3.8 billion. The division is seeing both new business and contract renewals, while online business is also doing well. Operating profit of 205 million is higher than last year's 167 million. E-commerce solutions revenue fell 0.6% compared against the pandemic spikes in demand this time last year. Revenue was 1.4 billion, and excluding exchange rate fluctuations, this was down 4%. Lower volumes in revenue in the business to consumer division meant operating profits fell to 102 million from 230 million. Extraordinarily high shipment volumes in the prior year meant postal parcels in Germany revenue fell almost 7% to 4.2 billion. Reduced efficiency caused by the decline meant operating profits fell 36% to 355 million. It's worth mentioning the Post and Parcels Germany, so that's 4.2 billion of revenue, but it's only out of 22.6 billion. So that's the equivalent, the German equivalent to Royal Mail. So that is probably in structural decline. It only makes up about 20% of the business though. So really what you are paying for is for DHL. So this is still making a decent profit on it, but you're probably going to eke out those profits. You're not going to see any growth in that side, but that's fine because it's such a tiny proportion of the business. Net debt stood at 13.7 billion at the end of March compared to 12.8 billion at the start of the year. Capital expenditure included additional investments in renewing Express division's intercontinental aircraft fleet. Advance payments were made for a new order of 6 additional Boeing B777 freighters. For the full year, the group plans to increase capital expenditure, excluding leases, to around 4.2 billion. Payment for the previously announced acquisition of Hilbrand Group means there was a free cash outflow of 197 million. In terms of the valuation, the company now trades at a P ratio of 9.9. Has a 10-year average PE of 13.8 and a prospective dividend yield in the next 12 months of 4.7%. And that's a dividend yield that's well covered. My view is similar to last time. I like the business. I like the valuation. I think it's a much better business than Royal Mail is, which is probably the closest comparison. I actually think this is a business that I think it's probably got quite a few long-term tailwinds. And even if it doesn't, I think at a P of 9.9 for that dividend yield, it's not even priced for growth anyway, but I think it's a very well run business and I would expect it to grow. John, what are your thoughts on the business, the results and the valuation?
Yeah, I think it's certainly from a valuation point of view, it's very reasonable and it's got well, I wouldn't say it's market beating, but it's certainly up there in terms of the yield at 4.7%. I don't know whether there are any sort of other headwinds. I mean, you mentioned obviously it's this almost the legacy business, a bit like Royal Mail, but it's certainly very competitive. I suppose with these numbers, it looks like it's, I suppose, withstanding the competition and delivering. So,
if you'll pardon the pun.
Yeah, would I buy shares? I think there are probably more exciting businesses that I would choose before Deutsche Post, but on the surface of it, it looks fairly solid.
Is it good enough for the watch list?
I think there are a lot of companies that I hold at the moment that have pulled back, as we've seen with the markets in general, that I prefer more, that I'd probably be more likely to top up on rather than going out and buying Deutsche Post. I think that would probably be my position. I
agree. That being said, yeah, I don't see a scenario where I would start a position, but I think it's a good enough business for my watch list. I do rate it. I think it's a very good business, but I'd be amazed if I bought this in the next 5 years. I don't see it happening. But so
it'll be on the watch list for a while.
I'll just enjoy watching it. It's not.
Fine.
But no, I think it's a good business, and I do like the valuation.
The business that we're coming on to, Shell. I don't know whether this is one that you're warming to or not, Sam. Certainly since the first time that we covered it in one of the early episodes on the show. So it's, I'm sure a company that everybody's heard of, the oil super major, which is the UK's largest company. They had their first quarter results out earlier this month with the headline figure of a $3.9 billion charge as a result of pulling out of Russia, leading net profits down 38% in the fourth quarter to $7.1 billion. Excluding this charge, however, with the oil price rise, EBITDA was up 16% to $19 billion. And if we break those results down a little further, the integrated gas division benefited from higher prices and the issues caused by the invasion in Ukraine. So whilst the production volumes declined 8% to 896,000 barrels of oil equivalent per day, partly as a result of higher maintenance, the higher prices led revenue $670 million higher and underlying cash profits 4% ahead of Q4 to $6.3 billion. In the upstream division, underlying cash profits were up 6% ahead of Q4 at $9 billion, despite a 4% decline in volumes with the divestment of the Permian business and milder weather. In marketing, including Shell's electric car charging and retail networks, cash profits were up 18% to $1.3 billion, with a fall in operating expenses offsetting a volume decline of 6%. In the chemicals and products division, profits more than doubled to $2 billion, with a margin improvement of $1.1 billion in refining and trading. Sales volumes were down from 3,475 tonnes to 3,330 tonnes. The renewable and energy solution division saw an exceptional market environment with underlying cash profits rising from $80 million to $521 million and a generation capacity for future contracts up 6% to 3.6 gigawatts. Free cash flow, excluding the proceeds from asset sales and non-core spending, were up from $3.2 billion to $10.3 billion, and net debt fell $4.1 billion to $48.5 billion, meaning that gearing also fell by 21.3%. Shell announced a 25-cent dividend, which is a 4% increase for the quarter, and $4 billion of the buyback program has now been completed, with a further $4.5 billion of share buybacks planned. Shell has a market capitalisation of £174.4 billion and trades at just 5.8 times earnings, compared with a 10-year average of 11.3, and it currently yields around 3.5%. I thought these results were excellent, despite the $3.9 billion hit from pulling out of Russia. But I suppose it's not really surprising with the geopolitical situation and the oil and gas market currently. Certainly in the short term, it looks set to continue, and Shell is, I suppose, continuing to print money. Certainly, if you compare it with BP, it's got a better LNG portfolio, and it certainly has less exposure to Russia than BP does or did. And it does trade at a significant discount when it's compared with its American peers like Exxon and Chevron, although I suppose they face a lighter touch regulation and there's little prospect of a windfall tax on their earnings. But I suppose, as with any oil company, it's very cyclical. And whilst it's made billions in profit currently, it wasn't so long ago when we were covering it on the show and we were talking about whether it had passed peak oil in the $20-30 a barrel, and Shell was trading at between £8 and £9 a share back then, compared with over £23 a share at the time of recording. I do own Shell, happy to continue owning it, and certainly at the moment. We were talking a little bit off air, it's in my ISA, and while it's churning out the cash at the moment, and I suppose some of it is going into buybacks, with that cash, I'm not reinvesting it into Shell shares. I'm putting it into sort of more the indexing strategy, because ultimately it's a cyclical business, but also a business that is in structural decline. And while it is investing in, I suppose, future energy use, I'm not as convinced by that as an investment as I suppose the more traditional part of the business. So that's my current strategy and my current view on Shell. Sam, what are your thoughts on these results and Shell as a company?
My initial thoughts were I didn't trust the PE of 5.8, which probably tells you something about the valuation. But I mean, that's like a tobacco PE, that is.
Yeah.
I suppose it's contingent on there not being a windfall tax and oil prices staying where they are, and no one really knows what's going to happen with those. They are very good results. You know, since we covered it 18 months ago at the bottom, and it's put up some really, really impressive results. I agree with the Russia write-off. I think that's the right thing to do, just because I think whether they write it off or not, even if they didn't sell or withdraw or whatever they've done, they're probably not getting those assets back anytime soon. So you can keep them on the balance sheet and make the numbers look a bit better. But I think the sensible thing to do is to just write them off, because it's probably best to assume they're not coming back. But yeah, I think if oil stays where it is, it's probably quite reasonably priced, but I wouldn't be comfortable making that bet as a shareholder.
Okay, fine. So even at the I suppose the current valuation, because oil is high, not convinced. Well, unsure about. Yeah,
because the future of the business is always going to be dependent on factors outside of the business's control, and just inherently, I don't like that. I think for me, it would always be uninvestable. That's the problem with it.
And if you were a current shareholder like myself, what would you be doing?
Let's have a look at the share price. I know that's a bad thing to do.
You want to look at the charts.
Oh yeah, so it's near all-time highs now, isn't it?
I mean, I've certainly had it at times when it's been about more like the £26 a share.
Yeah, but it's close, 23.
Yeah.
I'd probably just take the money and run, because it's a cyclical. And yeah, I mean, look, you look at the graph. It's gone from like under £10 a share to over 20 in a year. To me, that's maybe it'll get better, but I struggle to see a better environment for Shell than this one. I just think it would make me nervous, but I would never have bought. That's the difference. So I'm always going to tell you to sell, and I would have told you to sell at the bottom, and I think I did.
Yeah, you did. But
I'm probably the wrong person to ask.
Yeah, and I think it's actually in my port. This is probably not a good thing, but it's the biggest position in my portfolio now.
Is it? I mean, that would make me a bit sweaty. I'm going to be honest with you.
Yeah, but then I mean, I got it first because I had shares in BG Group, and then when Shell bought BG out in must have been 2015, 2016, or could have been a bit longer ago. No, I think it was 2016. Or certainly that I think that's when the deal completed. It was a lot cheaper, and I must have got it about sort of £15 a share, something like that. Had very juicy dividends, and they hadn't cut the dividends until COVID. I think that was the first time since the Second World War that they cut them. So had very juicy dividends, and just been reinvesting the dividends, rode it all the way up to 26, and then all the way down to 8, and now back up to 23. But with the biggest position in the portfolio, so I suppose it has been a bit of a sweaty one. But the exit strategy is those earnings the earnings that are being paid in dividends to go into, I suppose, businesses that may have more long-term growth, or the world index, I suppose.
What do you think about trimming it?
I suppose in the current environment, I appreciate it's got a lot going for it, which absolutely could change. And I suppose also, if you had a more general slowdown in the global economy and demand fell, despite the sort of the Russia situation, that could, I suppose, lead prices lower. So,
for a cyclical business like this, don't you think this is probably the optimum environment, really? So if you were to try, I know you shouldn't try and guess where you are in the cycle, but I'd be pretty confident you're closer to the top than the bottom.
I suppose what I've been telling myself is, do I give it another year? So you wouldn't, you'd get out now.
I'd get out now, yeah.
Get out now, yeah. So
you're like the drug addict looking for one more hit, and then he's going to quit.
Yeah, and I did, a confession. I did top up a little bit on the way down, and I think it was sort of April, May 2020, and I bought a few more shares at about £13.
Oh.
Yeah, but they at the time when we were then recording about 18 months ago, they were down to about 8. So it didn't feel so smart then. But yeah, I was like, had I caught the bottom? But no, this is.
It does show that you don't need to catch the bottom to do very well.
Fool's game. But anyway, now we're back. Yeah, back up to 23, and we've had a few divvies in between. So I will think on it, Sam. Anyway. Okay, so next company is Sage. Sam, do you want to give a bit of background about Sage? Because not everyone will necessarily have heard of it.
Yeah, I think this is the first time we've actually covered it on the show, but Sage do accounting software for businesses. That's basically their bread and butter. So they have come out with their half-year results. And yes, in terms of the KPIs, they've had annualized recurring revenue was up 10% to 1.784 billion. Renewal rate by value was up 3 percentage points to 100%. The percentage of subscription penetration was up 6 percentage points to 74%. And the percentage of Sage Business Cloud penetration was up 7 percentage points to 72%. Statutory revenue was basically flat at 934 million. It was actually down 3 million. Operating profit is up slightly from 203 to 204 million, and the operating profit margin is up slightly from 21.7 to 21.8%. We go into the results in more detail. Organic recurring revenue increased by 8% to 866 million, underpinned by Sage Business Cloud growth of 21% to 572 million. Organic total revenue grew by 5% to 924 million. Organic operating profit increased by 4% to 184 million, representing a margin of 19.9%, and that's down from 20.2% in the first half last year. Following a period of additional strategic investment to accelerate growth, organic operating margin has trended upwards from 18.4% in the second half of 2021. Statutory operating profit remains stable, including non-recurring net gains of 55 million driven by disposals. Strong underlying cash conversion of 120%, and that's down from 133% a year ago, reflects growth in subscription revenue and continued good working capital management. Robust balance sheet with about £1.2 billion of cash and available liquidity, and net debt to EBITDA ratio of 1.5x, which is very low actually. Interim dividend was up 4% to 6.3p a share. Annualized recurring revenue up 10% to 1.784 billion. Reflecting strong performance across all regions with growth balance between new and existing customers. Sage added 150 million of annualized recurring revenue through new customer acquisitions since the first half last year, up from 110 million a year earlier. Cloud native annualized recurring revenue was up 43% to 424 million, driven by new competitors and supported by migrations from cloud connected and desktop products. Renewal rate by value of 100% ahead of last year, reflected improved renewal rates and strong sales to existing customers. Sage Business Cloud penetration of 72%, enabling more customers to connect to Sage's cloud service and ecosystem via the digital network. It also highlights strong performance in key cloud native solutions, together with continued growth in the Sage 50 and Sage 200 franchise. They accelerated their strategy for growth by acquiring Brightpearl, a cloud-native retail operations and management system. They disposed of the Sage business in Switzerland and the South African payroll outsourcing business, increasing the focus on core geographies and completing the group's disposal program. Sage's outlook remains unchanged, and they continue to expect organic recurring revenue growth in the region of 8 to 9% for the 2022 year, driven by strength in Sage Business Cloud and in cloud-native revenues in particular. They also expect other revenue to continue to decline in line with their strategy. Organic operating margin is expected to trend upwards. It's basically the reason that the other revenue is declining is they're moving from the traditional products to the cloud and subscription products. So that's why they're basically cannibalizing themselves. In terms of the organic revenue by portfolio, the cloud-native recurring revenue for the half was up 44% to 187 million. Cloud connected was up 13% to 385 million. Products with potential to migrate was down 10% to 225 million. Non-Sage Business Cloud was down 14%, 69 million. In terms of the valuation, the business trades at a market cap of 6.66 billion and has a PE ratio of about 23. I think it's quite interesting. So these figures are actually, I've never taken a look at Sage before. I know what they do. My impression from work is they were a bit slow to the subscription side of the business. It's quite competitive because you've got Sage, QuickBooks, which I think in terms of the functionality is actually the worst one. Quite a few people in the office call it shitbox, but a bit of trivia for you there. But the real, like, if we're recommending a software to a client, we'd always recommend Xero. That's one we recommend as the best one. So Sage are a bit late to the party. However, these figures are quite. Sorry, go on.
I was going to say, who's the parent company of Xero, or is it
Xero is listed in Australia? So
it's
it's an Australian company. So it's basically like Sage but Australian, but they've really done well in the UK market. I actually think these figures are quite good. I think the valuation is pretty reasonable at 23. I think it's in Terry Smith's portfolio. I think it's on the naughty list, but he's stuck with it because he likes it, and I think he likes the future of it. One thing that's quite interesting is in the last few years, Making Tax Digital's come in, and that's basically where you've got to do quarterly reporting if you're operating a business, or if you're operating a company, or if you're doing VAT, you've got to do it quarterly, and you've got to do it online in real time. So it makes it much easier to collect the tax and make sure everyone pays the right amount. But that's come in, and that's been a huge success from the revenues point of view. So they've now expanded it. So in 2024, that's actually coming in for income tax. Obviously for Sage, that's a big opportunity because you're going to have to start doing, say you've got, for example, like if you've got a rental portfolio, and I think if the rent's over 10K a year, which a lot of landlords are in that position, you only need a couple of properties to get there. You've got to then do a quarterly Making Tax Digital tax return. So, Sage and Xero, once it's out, they'll be getting on that with software. So there's 6 million people in self-assessment. A lot of them are self-employed people and stuff where they've maybe not come into MTD quite yet. That is quite a big opportunity for them as well. They'll probably get a lot of growth just from when MTD comes in for self-assessment in a couple of years. And I mean, the cloud side it's going to continue to grow. The subscriptions is going to continue to grow. It's got a lot of tailwinds in its favor. It's not, I don't think, maybe it is the market leader still in the UK, but I don't think it's, my concern is the numbers are all right, but for the tailwinds it's got, I feel like it should be performing a lot better. What do you think, John?
I know a lot less about Sage and I suppose the product than you do, Sam, but I suppose on the surface of it, it doesn't look that cheap. And you mentioned Xero and QuickBooks. If Xero is the better software, I mean, is Sage's market share going to continue to decline and essentially losing out to Xero, even when you've got the tailwinds that might be coming with
I don't know what the market share is like, is the thing, but it could lose market share and still do very well. Because what they used to do is it used to be like kind of Microsoft Office. They used to sell you a disc once and you'd use that forever. Whereas now you pay a monthly fee. So they could have a smaller share of a much larger market because they're not just selling one-offs. People are paying every single month. So they could, and the thing is as well, even if you're on Sage and Xero is better, once you've got all your records on there, and the information it does give is very good. It can give you real-time information on your business. It's got all your history. You can't move that over very easily.
I see.
So once you're on Sage, it takes a lot for you to switch to Xero. So where Zero is going to get you is where if they're coming in, they've got the marketing and they're better on the marketing and they're getting better recommendations. For example, when MTD comes in for self-assessment, are people going to be recommending Zero to their friends? And then once they're in, it's very hard for Sage to get them back. But that's not necessarily a problem if they can continue growing anyway. But yeah, I think these are decent results. I'd heard quite a bit about Sage and the performance, so I went in probably expecting the figures to be worse than they were, but I still wouldn't invest in it.
Would you add it to your watch list? Is it something?
Probably not. No, I'd maybe take a look at Zero, but I've heard Zero's quite expensive. I've never actually taken a proper look at it, but I think it's got a silly PE.
It might be one for to cover. We haven't really covered Australia at all.
But we've never done an Australian stock.
We'll have to have a look. We'll dig into it and look when the results are coming out for Zero. Then okay, on to a favourite of the show and our US company for the week, which is Disney. They had their second quarter results out last week with revenue rising 23% to $19.2 billion and operating profit up 50% to $3.7 billion with a bounce back in the US park business. And the number of new subscribers for their Disney Plus also surprised after disappointing results from Netflix recently. So within the media and entertainment distribution business, Disney Plus subscriptions rose by 7.9 million subscribers to 44.4 million subscribers in North America, and total Disney Plus subscribers were up 33% to 137.7 million globally. This led total direct consumer revenue to rise 23% to $4.9 billion, and the average monthly revenue per paid subscriber up 9% to $4.35 globally. However, higher marketing and production technology costs widened the underlying operating losses for the direct-to-consumer division to $887 million. The cable TV business also faced higher production costs, meaning that the operating profit for the media and entertainment division as a whole fell 32% to $1.9 billion. In the Parks, Experience and Products division, revenue soared to $6.7 billion, up from $3.2 billion a year ago, with people returning to the parks, increased guest spending, and increased guest numbers, helping offset the higher costs. Operating profit came in at $1.8 billion, compared with a $406 million loss a year ago. Merchandise licensing was also performing strongly with higher sales, and free cash flow was up 10% to $686 million, with net debt standing at $38.8 billion. In terms of valuation, Disney has a market capitalization of $189.5 billion and trades at 20 times earnings, compared with a 10-year average of around 23. I thought these were very good results, with park profits returning as the US leaves COVID behind, whilst also maintaining the subscriber growth for the direct consumer business via Disney Plus. And that certainly wasn't something that was guaranteed after the recent figures that we mentioned from Netflix that we also covered. I still think Disney is a fantastic business with its parks, its streaming business, which is still in growth mode, and it's very valuable intellectual property. There's still quite a lot of debt on the balance sheet after the acquisition of 21st Century Fox. However, it wouldn't put me off buying Disney, although that debt could get a bit more expensive in the near term. Disney has pulled back a lot from its highs last year, and I still think it's a buy. I topped up on Disney shares myself earlier in the week after these results, and I'm very happy to hold it for the long term. It's one that I sleep easily at night with. Sam, what do you think about these results from Disney?
I thought they were very good results. Operationally, it's all going well. Disney Plus, the subscriber growth, very encouraging. It's worth mentioning a lot of those subscribers, I think, came from like India, where they're charging something ridiculously low a month. So it's got a very low average revenue per user, but I think it's so cheap. And the strategy they're adopting is the strategy that we've been saying really that we want them to do. I want it as low as possible and get as many people in, give them the IP that they know and love, and then start upping the prices. At the minute, you just want to get as many subscribers as possible. And they're starting to really, I think they're going to spend something like I'm sure. So I think they're going to outspend Netflix on content this year. Or if they're not going to outspend, they're very close. I think they're going to outspend. And they're probably the only company that can do that. And they're outspending on better IP. I think, I just think it's a wonderful business. I think these are very good results. I think a PE of 20, I know the 10-year average is only 22, but that 10-year average, Disney Plus didn't exist 10 years ago.
Yeah.
So you're getting it at a good price without Disney Plus. So if you think Disney Plus is going to do well, you're almost getting that for free. I actually bought shares today after looking at these results as part of the prep for the show. I've held it before, and I think I sold it because there was someone else I wanted to buy more. And then I had to sell Facebook to buy this. But no, I just think it's a fantastic business. And I think the valuation is just, well, I think Mr. Market's given us a good deal there.
Okay. So of the companies then this week, which would you, I appreciate you may own a couple already. Three. Yeah.
You're on four, aren't you?
I'm on four. Which, if you were taking a position to start with, which would you buy? And maybe if you were going to top up on one, I suppose you've already given that away. You've topped up on Disney. If you were a new investor and you were buying one of these stocks, which do you think you'd go for?
If I'm a new investor, I'd go with Disney.
Okay.
Because you're going to sleep best at night with it, I think. I think the best value, the best bang for your buck is probably Airtel Africa. But as a new investor, you could be in for a bumpy ride. It's not a business you're going to know as well, and it's higher risk. But I think you could probably do a lot better in Airtel Africa than Disney. But I think you can do very well in Disney. I do like it is between the two for me. But I think if you were of the mold where you were more concerned about sleeping well at night, you'd probably pick Disney. If you're not, I'd say Airtel. But if you were to put a gun to my head and say which one do I think would perform best over the next 5 years, I would probably be picking Airtel Africa. But I think with Disney, you're getting that very good performance, but probably with less risk. So it's a close second for me. What about you?
I think I'd go for Disney. I think it's what I've topped up on, but also if I were a new investor, I'd buy Disney. I think it's the highest quality business out of any of the ones we've covered. And I think being the highest quality, I think in the long term, it's probably going to perform most strongly. So yeah, I'd buy Disney and hold it, reinvest the dividends, and sort of forget about it.
Okay, well, I think that's everything then.
Okay, well, thank you again for listening, and we'll see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.